Please welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Mysogland.
So the first question today is, when you buy a business, what exactly are you buying? And so in almost every situation here, you're purchasing the assets of a company. All right. So that any advisor would probably tell you that you want to buy assets rather than stock. But most sellers want you to buy the stock because of the tax consequences. So let's just take a look at the two entities, the sub S. So the sub S corporation and LLCs, most of them are taxed as an S. And what that means is that when they take the net income and they divide it by the number of shareholders, and that's what's put on their K-1s, and then they are taxed based on their individual tax bracket. A C Corp is double taxation. All right. So the corporation is taxed, and then the owner is also taxed. And so you can see why the C corporation is, it's really good for large corporations. It's not so good for small businesses. So again, for many reasons, you don't want to purchase the business by buying the stock. And like I said, the primary reason is that the corporation may have liabilities that aren't apparent. If you buy the stock, the inherent liabilities, known or unknown, go with the stockholder. So if you buy the stock, you're also buying these liabilities. And then second, and probably most important, is you won't be able to depreciate your purchase price. So substantially all of your purchase price will be allocated to the basis of the stock, and then you'll have to wait until you sell the stock to deduct the cost of the acquisition. So then what exactly are you buying under an asset sale? Well, you're purchasing the furniture, fixtures, equipment, inventory, goodwill, trademarks, trade names, and what you're buying is assets that are free and clear of any liens and liabilities. So the mechanics of the sale are kind of like this. You form an entity. That entity buys the assets of the target, and you bring them into your entity. And then you, again, based on the allocation of purchase price, that is your opening balance sheet. So you might be wondering, what do you do about the cash and accounts receivable? That depends. I mean, there's a couple different scenarios. They can or cannot go with. They may or may not go with the business. It just kind of depends on the business as well as how good the accounts receivable and accounts payable are. Many deals these days are including net working capital, which includes your inventory, AR, and AP. So, again, outside of the assets that I described, the current assets are up for negotiation of whether or not they are or are not included. The next question is, this fellow wants to get into selling businesses for a living. Now, I'm assuming that you're looking at getting to become a business broker or an investment banker, as opposed to I want to buy companies and sell them myself. Have a portfolio of companies and basically have your own little portfolio of small and mid-sized companies. So, like I said, I'm assuming you want to be a broker. So let's talk through this. Number one, age and experience matter. And I paid that tuition firsthand. I came right out of college into the business brokerage industry. I wanted to be an investment banker. At that time, none of the investment banks had apprenticeship programs. So I did. So I couldn't go right into investment banking, so I went into business brokerage and found out really quick that age and experience matters. So you can't expect a business owner to entrust most of their net worth, which is tied up in the business, to someone young, unless you have the experience that indicates that you have what you're doing. So number 2, you have to have a runway. And when I say a runway, it takes time to sell a company. Normally between 6 and 12 months to do it. So you have to have enough personal capital to keep you alive while you're selling the company. And oh, by the way, it's also a challenge that a lot of companies don't sell. So, when you look at the odds, you need to have an inventory stacked up, and you need to have the capital behind you in order to keep you alive while you are procuring buyers. Number 3, you need an understanding of financial statements and sources of capital. You have to have a basic understanding of that. You can backfill it with, like in our shop. We have, I do a lot of the business valuation and things like that. So, but you do need to be able to understand financial statements and how a business operates and sources of capital for the buyers. Number 4, you need to understand how to evaluate buyers in relation to your deals. So not all buyers are equal. And when I say not all buyers are equal, I mean there's different buyers for different businesses. And some may be financial buyers where they're buying themselves a job. Others are strategic buyers where they're looking at growing through acquisition. You have to be able to determine, number 1, the credibility of your buyer. Number 2, you have to understand how that buyer, what is that post-closing, what does that deal look like for that buyer? Number 5, you need to know that you're in sales. Your business, the business that you're selling is your product. You're not there to fix the business, but sell it. There are plenty of firms out there, a lot of exit planning firms that help fix and prepare companies for sale. As a broker or a deal guy or girl, that's your job. You're in sales. You're not a consultant. Number 6, you need to understand that the process is relational between the buyer and seller. There are a lot of dynamics in play, but most of which you don't know about. And you have to understand that everyone, and all parties included, everyone has baggage, and there's dynamics that play into getting the deal done. Number 7, you need to understand that the best buyer may not be paying the highest price. Number 8, you need to understand that you're operating in the world of the irrational for both buyers and sellers. So you need to understand to expect decisions and positions that are counterintuitive to how it might look on your spreadsheet. And and that's a tough part, that where you are forced to be in a position where closer you get to your paycheck, the less control you have. And when you have people operating in the world of the irrational, that's not for the faint of heart. So number 9, you need to know the difference between value and price. Value is the worth to somebody, price is negotiated. Number 10, you need to know that the closer you are to closing, and I mentioned this earlier, the less control you have. And then the bonus one, you need to understand that just procuring a buyer, just finding one, right, is about 30% of the job. Taking that buyer and carrying him or her over the finish line with all the things that can go wrong, all the things that need to go right, that's where you earn your fee. Well, that about wraps it up. But before you go, would you like to receive a weekly newsletter of curated articles that I've stumbled upon or I'm writing about regarding business value and making a company saleable? Well, if so, go to defendersofbusinessvalue.com and sign up for the newsletter. Now, if you have a question that you would like answered, go to, again, the website, defendersofbusinessvalue.com, and push the appropriate button, or you can email me at ed@defendersofbusinessvalue.com, or you can reach me at Twitter at Ed Miso. Thank you so much for spending time with me. If I can ever be of help to you in any way, please don't hesitate to reach out. Have a good weekend, and I'll see you next week.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.